Welcome back to the Deep Dive. Before the break, we were just talking about some key factors to consider for 2025, like the impact of the U.S. election, and how its policy shifts could create opportunities, but also a fair bit of uncertainty.
Yeah, definitely a balancing act.
What to deal with that?
Well, Goldman Sachs, for instance, they predict the U.S. might actually outperform other developed markets.
Interesting.
But this could be fueled by a more aggressive approach to tariffs, which could have global consequences.
So a potential win for the U.S., but maybe at the expense of others? That seems like a risky strategy, in an interconnected global economy.
Yeah, that's the crux of it. Goldman Sachs suggests this potential for U.S. outperformance could actually lead to a stronger U.S. dollar as investors seek a safe haven. However, a strong dollar could also make U.S. exports less competitive, potentially offsetting some of those benefits.
So it's not a clear-cut win for the U.S.
Yeah.
It seems like there's a lot of what ifs and potential unintended consequences to consider.
A lot of moving parts for sure. The global economy is like a complex web, and any major policy shift can have ripple effects that are difficult to predict with complete accuracy.
Okay, on to another risk factor that Goldman Sachs highlights, debt sustainability. They point out that U.S. government debt is increasing, while traditional buyers like central banks are scaling back.
Right.
How does this impact the average investor?
Well, this is where things get interesting. With less demand for U.S. debt, investors might demand higher returns to hold those bonds. In simpler terms, borrowing becomes more expensive for the U.S. government, which could push interest rates higher across the board.
So not only could government borrowing become more expensive, but it could trickle down and make it more expensive for companies and individuals to borrow as well.
Exactly. And this could create some turbulence in the markets as investors adjust to these shifts.
Yikes, it sounds like there are some serious challenges on the horizon. But amidst all this talk about economic and political risks, it's easy to forget about the potential for growth and innovation. What are some of the positive forces at play that investors should be aware of?
I think UBS highlights what they call the 5Ds as megatrends shaping the decade ahead.
5Ds.
Debt, deglobalization, demographics, decarbonization, and digitalization. They acknowledge these forces will create both opportunities and risks. But overall, they believe these trends could ultimately lead to higher growth.
So it's not all doom and gloom. It sounds like these 5Ds are powerful forces reshaping the global landscape and creating new opportunities for investors who can understand and adapt to them.
Precisely. And amidst all this, UBS remains quite optimistic about U.S. equities, even predicting the S&P 500 could reach 6,600 by the end of 2025.
Wow, that's a bold prediction, especially considering the risks we just discussed.
It is, but it highlights their belief that the long-term growth potential of the U.S. market remains intact, even with those risks. However, they are more cautious about Europe and China, given the heightened geopolitical and trade-related uncertainties.
So it's not a blanket optimism, it's about being selective and strategic with your investments.
Absolutely. And when it comes to being strategic, it's important to remember that demographics are shifting, with a global population that's aging, leading to a growing demand for healthcare, senior living facilities, and other services catering to an older demographic.
It's a reminder that investing isn't just about chasing the latest hot stock.
Yeah.
It's about understanding the long-term trends that are reshaping our world.
Right. And if we connect this demographic trend with the theme of decarbonization, another potential growth area emerges: clean energy and power infrastructure.
I see where you're going with this.
Yeah.
UBS seems particularly bullish on this sector, seeing it as one of the biggest investment opportunities of the decade.
They have good reason to be. Investment in clean energy is already surpassing investment in fossil fuels, a trend likely to accelerate with government policies and consumer preferences increasingly favoring sustainability.
It sounds like the energy transition isn't just a moral imperative, it's also a powerful economic force creating a wealth of opportunities for investors.
Now, let's circle back to the elephant in the room, or perhaps we should say the algorithm in the room: artificial intelligence.
AI. It's not just hype. AI is a truly transformative technology with the potential to revolutionize countless industries, presenting exciting opportunities for investors across both public and private markets.
It feels like the dot-com boom all over again, but this time with algorithms instead of websites.
There are definitely parallels. We're still in the early innings of the AI revolution, which means lots of uncertainty, potential disruption, but also significant opportunity for those who can spot the winners.
So what advice do the experts have for investors who are looking to capitalize on the AI boom? Where should they focus their attention? Well, UBS suggests a three-pronged approach. First, focus on the picks and shovels of AI.
Okay.
The companies providing the infrastructure and tools for AI development, like semiconductors, cloud computing, data storage, the essential building blocks of the AI ecosystem.
Makes sense. Kind of like investing in Levi Strauss during the gold rush, right?
Yeah.
You might not strike gold yourself, but you'll profit from those who do.
Exactly. Second, look beyond just the software giants like, your Microsofts and your Googles. There are opportunities in companies applying AI in more niche or specialized areas.
So it's about digging a little deeper and finding those hidden gems, those companies that are using AI to solve real-world problems and create value in specific industries.
Exactly. And finally, diversification is key. Don't put all your eggs in one AI basket. Spread your investments across different types of companies, sectors, and stages of development.
Solid advice. All this talk about AI's transformative potential makes me wonder, what are the potential downsides? What risks should investors be aware of?
That's a great question. I think several reports touch on this, particularly concerning the potential impact on jobs. While AI is expected to boost productivity and drive economic growth, it could also automate certain tasks, potentially leading to job displacement in some sectors.
Yeah, the robots are coming for our jobs.
Right.
Or at least that's the fear.
It's not quite that simple. AI is a tool. And like any tool, it can be used for good or for ill. The key is to manage the transition thoughtfully, providing retraining programs and support for workers affected by these technological shifts.
So it's not just about the technology itself, it's about managing the social and economic consequences of its adoption.
Absolutely. And beyond the economic concerns, there are ethical and regulatory considerations unique to AI. For example, there are concerns about bias in AI algorithms, particularly when used for decisions impacting people's lives, like loan approvals, criminal justice sentencing.
Yeah, that's a serious concern. We wouldn't want machines perpetuating existing inequalities or making biased decisions that could have a negative impact on people's lives.
Absolutely. Regulation is crucial in this space. Governments are starting to grapple with the challenge of regulating AI to ensure its safe and ethical use.
It sounds like investing in AI isn't just about understanding the technology. It's also about understanding the broader societal and political context in which it's developing.
Yeah.
What other trends are shaping the 2025 market outlook?
Well, deglobalization is a major trend to watch. For decades, we've seen increasing interconnectedness between countries. However, in recent years, there's been a backlash against globalization, fueled by concerns about job losses, national security, and the concentration of economic power.
So is this the end of globalization as we know it? Are we retreating into isolated economies?
It's unlikely we'll see a complete reversal of globalization, but we are seeing a shift towards more regionalized or localized supply chains, as companies and countries seek to reduce their reliance on a single source for critical goods and materials.
So instead of a global village, it's more like a collection of interconnected neighborhoods, each with its strengths and vulnerabilities. What does this mean for investors?
Companies with diversified supply chains and operations in multiple regions are likely to be more resilient in a deglobalized world. Investors need to consider these factors when evaluating companies and understand how their exposure to specific regions might impact their performance in a less globalized environment.
It seems like deglobalization adds another layer of complexity to the 2025 market outlook.
Indeed. And it's interconnected with many of the other trends we've discussed. For example, rising geopolitical tensions can exacerbate deglobalization trends, as countries become more wary of relying on potential adversaries for essential goods.
It's a reminder that the global economy is like a giant spider web, right? Tug on one thread and the whole thing vibrates. Speaking of interconnectedness, let's talk about the energy transition.
Yeah, the transition away from fossil fuels is a massive undertaking that will require trillions of dollars in investment over the coming decades.
We're talking about a complete overhaul of the world's energy infrastructure, a shift that will create both challenges and opportunities.
Right, exactly. This transition will create both winners and losers. Companies in the fossil fuel industry are likely to face significant challenges as demand for their products declines, but companies involved in renewable energy, energy storage, and other clean technologies are poised to benefit tremendously from this shift.
So for investors, it's about understanding which side of history you want to be on, backing the companies and technologies that are shaping a sustainable future.
Well said. Beyond the direct investment implications, the energy transition will also have a ripple effect across other industries. For example, the transportation sector will need to adapt as electric vehicles become more prevalent, and the materials sector will see increased demand for metals and minerals used in clean energy technologies.
It's another reminder that investing isn't just about picking individual stocks. It's about understanding the big picture trends that are shaping the world around us and identifying the companies that are well positioned to benefit from those trends.
Precisely. That's what we've been trying to do in this deep dive. Provide you with a framework for understanding the 2025 market outlook and the key factors that are likely to influence investment decisions and the global economy in the year ahead.
It's been a whirlwind tour of the financial landscape. And speaking of whirlwind tours, I feel like we've barely scratched the surface on some of these topics.
You're right, there's always more to explore. But that's the beauty of investing. It's a constant learning process.
Well said. Before we wrap things up, there's one more topic I wanted to touch on. Real estate.
Okay.
Earlier you mentioned that real estate and infrastructure could offer uncorrelated returns and attractive yield gaps compared to public markets.
Yeah, both JPMorgan and UBS highlight private market assets, like real estate, as potential sources of portfolio diversification and stable income.
But real estate has been a bit of a roller coaster ride lately, hasn't it? We've seen soaring prices, then cooling markets, and now rising interest rates are adding to the uncertainty.
It's true that the real estate market is cyclical and can be influenced by a variety of factors, including interest rates, economic growth, and demographic trends. But that doesn't mean it's a bad investment. In fact, for investors with a long-term horizon, real estate can be an excellent way to build wealth and generate passive income.
So what's the outlook for real estate in 2025 and beyond?
Well, it varies depending on the specific type of real estate and the location. But overall, the reports we've analyzed suggest that there are still opportunities in real estate, particularly in certain niche sectors, and in markets with strong underlying fundamentals.
Like what? Give us some examples.
Well, UBS highlights logistics properties, data centers, and telecommunication towers as sectors with strong potential. These types of properties benefit from trends like e-commerce growth and the increasing demand for data storage and connectivity.
Those are definitely hot areas right now.
They are, and UBS also points to the potential for rising rental growth in certain markets, which could drive capital appreciation for real estate investors.
So it's not just about owning a piece of property. It's about owning the right property in the right location. And it sounds like understanding those underlying trends like e-commerce growth and the demand for data is crucial to making smart investments in real estate.
Precisely. It's about aligning your investments with the forces that are shaping the future.
Okay, so we've covered a lot of ground today, from the macroeconomic trends to specific asset classes, and even touched on some alternative investment ideas. But before we wrap up, I want to circle back to something you mentioned earlier, the potential for AI to disrupt the job market. It's a topic that's been on a lot of people's minds lately.
It's a valid concern, and it's not just about blue-collar jobs being replaced by robots. AI has the potential to disrupt white-collar jobs as well.
It's a bit unsettling. What can be done to mitigate the potential negative impacts of AI on employment? Are there any solutions being proposed?
Well, there are several ideas being explored, from retraining programs to universal basic income. But one of the most promising solutions, in my opinion, is to focus on developing AI in a way that complements human skills, rather than replacing them entirely.
So instead of thinking of AI as a threat, we should think of it as a tool that can augment human capabilities and create new opportunities.
Exactly. AI is already being used in healthcare to assist doctors with diagnoses, in education, to personalize learning experiences, and in finance, to detect fraud and manage risk.
It sounds like AI has the potential to make our lives easier and more efficient, but only if we use it wisely.
Exactly. It all comes down to how we choose to develop and deploy this powerful technology.
Okay, we've covered a lot of ground today. We've talked about the big picture trends shaping the 2025 market outlook, explored specific investment opportunities in various asset classes, and even delved into some of the ethical and societal implications of AI. It's been an incredibly insightful journey.
It has. But before we sign off, I want to leave our listeners with one final thought. We've discussed several potential risks and challenges in the year ahead. But it's important to remember that markets are ultimately driven by human ingenuity, innovation, and the relentless pursuit of progress.
It's a reminder that even in the face of challenges, there's always reason to be optimistic about the future.
Well said. Now, let's move on to our final segment where we'll summarize the key takeaways from our deep dive and leave you with a thought-provoking question to ponder as you navigate the 2025 market landscape.